We just had yesterday one of the strongest performances in the market in quite some time. However, that was not reflective when we look at UNH. They were pretty much down around 1%, and to make matters even worse, for a company that has been on a very large downward trend for quite some time, is down in the pre-market as of right now more than 9%. In fact, if you were looking at this data just a few minutes ago, it was down around 12 to 13, and we're going to understand what is going on with this company. What is the valuation saying? Are we looking at an incredible opportunity, or should we really run away from this stock? And we also have to draw your attention that over the last year, it's down 26%, more than 1/4 of their market cap wiped off. And over the last 10 years, they're up 217%, which we will compare to the S&P's performance. Also worth noting, not only are they a 52-week low as of right now, but when the market opens, they're going to be at a new 52-week low. This looks like it will end up being a 5-year low for a company. So if you've been holding this company in just a matter of years, you would have gained pretty much nothing. And we can in fact see 52-week high now seems like a long time ago at the $631 mark. Now, Wall Street do give this a strong buy rating, as well as Seeking Alpha, who do believe this is a buy, one for consideration in the portfolio. And whilst we have had a fairly mixed performance in the market year to date, again, we are just talking about the last few months, UNH has been one of the worst performers, down 25%, and we do believe upon market open, this will be down more than 30%. So we could pretty much be seeing a company, a very large one in fact, that has had 1/3 of its market cap just wiped off like that. And the real reason why we are seeing a double-digit drop in the pre-market is, and it's never good news when you hear this word, suspending their annual forecast. Now, if you remember, and we will touch upon this in our earnings review from just a few days ago, they also cut the guidance. So this is pretty much a double whammy. Firstly, we heard that they cut the guidance. Now, in fact, they are fully suspending this, not giving any indication of what we could see for 2025. And the second point to note, probably equally as important, is that the CEO has in fact stepped down. And if we take a look at the Financial Times, who are also covering this, they in fact note that they have been told this is due for personal reasons. Regardless, the market doesn't like this, and that is why we are seeing an incredible drop, something that some investors may believe is giving an incredible opportunity. In fact, many investors believe just days ago this was looking like a glorious chance for one of the best value plays in the market. Now, is this one in fact that we should steer clear of? Is this going further, or what is the valuation pointing to? Again, we're going to cover, and we'll also just highlight here, they have released in fact a press memo where it talks about the leadership transition, and they are expecting to return to growth in 2026. And if you remember from the 2025 review from Q1, the main reason why in fact they missed their earnings per share was that their medical costs were a lot higher than what they anticipated. But ultimately, as we can see and we'll highlight shortly, they expect growth long-term 13 to 16%. So we could be talking about a very strong opportunity for long-term growth for those that do believe they can stomach any further drops and believe in the long term of UnitedHealth. But just as a reminder for those that missed the previous episode, they cut their guidance in fact for 2025 to 2465 2515 when they were initially expecting 26 to 2650. Now they have completely removed all of this and said that they will not in fact be disclosing what they anticipate for the full year. That is always going to spook the market, and that is what we have seen. But remember, Warren Buffett, he always talks about buying when there is blood in the market, when there is fear, as opposed to buying when there is greed. Possibly this could be one to fit that narrative. And we also want to highlight, as we will do, the company does have some very strong financial metrics. They grew their revenue around 10% from the same quarter last year. They served more members year to date, that is up 780. As we just highlighted, their expectation is to move long-term 13 to 16%. We say long-term in fact, however, management have pinpointed this to 2026. So again, it will depend if you can stomach this over the longer term. And also bear in mind, the news that has been released isn't financial information. Yes, the company's guidance has been suspended. We already just heard days ago where they did cut the guidance, and I guess you have to factor in whether or not the CEO stepping down is something that will materially affect the numbers moving forwards, or if you believe, one, it could be due to the personal reasons stated in the Financial Times, or something that won't have an adverse effect over the longer term. Also worth highlighting, as we said, numbers were very strong, 10% increase from the same quarter last year, but also a 10% increase just the previous quarter. We do also like the fact their net margin increased 5.7% above the previous quarter at 5.5%, so there is quite a lot to like about the company. There are a lot of things that you do need to be aware of, and that is why ultimately when we look at companies and our valuation process, we always incorporate a margin of safety. Now, worth noting that over the next 4 quarters, from the information we previously had, they were expecting only one of them to be growth, and they have a 75% track record, 3 out of 4 beats. Notably, they did miss that most recent quarter, and based on the closing price, in fact, of what we saw yesterday, they were trading on December 2026 numbers at a forward P of 12.4. This is only going to go much lower. Again, could be one of the best opportunities if you believe in this long term. At the same time, nobody knows, this could continue to go on a downward trend for a very long period. Now, we typically like to talk about valuation for companies at a starting point, looking at their forward PE against their 5-year average. Right now, 14. We do anticipate this to go down to at least 13 upon market open, so that will be the lowest it has been over the last 5 years, significantly below the 5-year average of 20.2. We are talking about severe undervaluation, and that is only reflective again on the yield at 2.2%. This will go higher, likely near the 3% mark, the highest probably they've ever offered in the company's history. When you look at the 5-year average, 1.42, we're talking about a double undervaluation signal, and we'll also touch upon the dividend safety shortly. But again, another model here with the blue tunnel reflecting the expected fair price. Nice to see that it hasn't at least decreased over the long term. Ideally, you do want to see it move upwards, but the real point to note here is that there is a massive disparity between where the company sits and the lower end. Again, market opens, this is only going to get even lower, so we are talking about a lot of points, talking purely on the valuation perspective, that the company is undervalued. But as you should know, we never look at companies purely on valuation. We also need to look at other factors. But putting it into perspective, as we are on the valuation point right now, whilst they do get a D+ on the overall rating, doesn't make sense as none of these in fact point to that figure. But what we can see, the sector is already trading a lot higher, so you are in fact getting a 19% discount. It will only get larger as the market opens, so you need to consider, does it deserve a discount in reality to the sector? And if it doesn't, then this could be a good opportunity. If it does deserve a discount, how much of a discount does it truly deserve? And that is what we will get to in the valuation. Also worth noting, as we've already pointed out, they are trading at the moment to a 30% discount to their own 5-year average, and pretty much consistent over the vast majority of valuation metrics. Not only is UNH trading at a large discount to their 5-year average, but also to a large discount to the sector overall. Again, this is what we would say at this stage, another undervaluation signal. Now, it's very important to understand that the S&P as a whole are trading at some very high forward figures. We can see the likes of Microsoft at a value of 30, Tesla at 103, but also others that you could consider to be questionable. However, what we have noticed with UNH, even before the drop today, it is sitting in a very favorable area, currently around the 12 mark, which only adds to the intrigue of understanding if this is a golden opportunity. And what's even more interesting is that over the last few weeks, we've actually seen analysts cut their price target on the company, but they've cut it to levels where there is still massive upside. In fact, some of these could give upside of 100%. We're talking a double just over the next year, although remember, purely based on analyst expectations. We have another analyst cutting the price target to $575, and they still remain this overweight point. Again, these are purely just signals that analysts believe the company still does look very strong in terms of the growth, in terms of the underlying metrics, and that the business isn't going anywhere anytime soon. And we have another one here cutting it to $520. Again, there is still upside if these analysts are to be believed, but what's quite important is to understand, does it actually deserve the discount against the sector? Now, on growth, they do get an F, yet when we look at year-on-year revenue and forward-looking, we're talking in the 8 to 10% region, which is marginally above the sector, in fact, at the 7 to 8%, but we do notice only a little bit lower than their 5-year of 10.5% and 9.5% respectively, with earnings per share probably where this company does get let down in terms of growth, anticipated 8% over the next 3 to 5 years. That is below the sector at 10 and also significantly below their own 5-year at 13.4, yet their profitability does come out very strong at an A+. Now gross margin in particular fairly weak at 22% when the sector sits at 60 and their own 5-year at 24.5, but what really looks strong is their net income margin. Yes, you might think 5.4% fairly low, but look at the sector, burning through cash, negative 2.5%, with their own 5-year average around a similar figure as the current at 5.6, and cash from operations, this company does generate a lot at 28.5 billion, above the 5-year at 24.5, and well above, in fact, the sector, which is burning through cash, negative 12 million. So you could argue actually it probably doesn't deserve a discount to the sector, and when the market opens today, the discount is only going to get even larger. So a quick recap for this part of the analysis: a buy from Seeking Alpha, a strong buy from Wall Street with a hold from Quant, D+ on valuation, F on growth with an A+ on profitability. Now worth also highlighting, the dividend score does still look very strong at 90, very safe. We've covered these two undervaluation signals, and also we like to note for companies that do pay dividends, this one is a fast grower, most recent June at 12%, so we are anticipating over the next few weeks another increase. And we can flag it was downgraded in April where it was at 99. Nonetheless, 90 still signals to us that a dividend cut for the company is highly unlikely. Now, key metrics from the 07-09 Great Recession: they maintained the dividend, didn't increase, didn't in fact cut it. They had plus 5% sales, well above in fact the S&P, which was negative 12, although they marginally trailed, negative 63, the S&P itself, negative 55. As already highlighted, nice double-digit increases to the dividend, on average 19% year on year over the last 10 years, and they've been increasing it in fact consecutively over the last 15. However, they've been paying a dividend for a much longer duration, last 32 years, without a reduction. Now getting into the underlying metrics, as always, free cash flow over earnings, which is susceptible to manipulation by management through accounting, below 60% is what we want to see. Gives us faith they can continue to offer double-digit increases like we have done. 31% on a trailing 12 month, expected to get lower, so no real worries so far based on the information. And this is what we love: free cash flow from companies, very rare, even though it's what we want, that consistently increase over the longer term. We're talking about near triple over the last 10 years. Yes, a drop into 2024, but it is anticipated to continue the upward trend to $31.30 over the next year. Whilst growth, whilst a little bit inconsistent, still very strong. We get double digit pretty much more often than not, 8% in 2024, and total sales has more than doubled over the last 10 years. One thing we would point out that is probably more relevant today than it has been, with share buybacks, we love this because it's companies returning excess cash to investor pockets. Whilst they haven't done that much over the last 10 years, with this massive drop we've seen in 2025, perhaps if management do believe the company share price are severely undervalued, we could see them ramp this up and authorize a very large share buyback program. Now, ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. We can note that pretty consistent every single year. And then we move on to the operating margin. We have already covered this in terms of analyzing margin overall against the sector. And whilst we do like 12% at a bare minimum, even the 8 to 9% range is above the sector, which, as we noted earlier, at least on the bottom line, they are burning through cash. And free cash flow margin pretty much straddling around that minimum 5%. In terms of the final metric here, the net debt to EBITDA, which correlates to both dividend safety, balance sheet strength, where we want to see below 3, and the numbers you see are the number of years it would take them to pay off all of their debt net of cash on hand. 1.39 2024, 1.2 trailing 12 month, expected to go lower over the next year, so it does look like balance sheet does look to be secure, and even with the downgrade to the dividend safety still at 90, very safe. Also worth highlighting, this is one institutions love with their 88% ownership. They sold 41 billion over the last year, but they bought more in fact during the same time frame at 54 billion, so clearly more bullish than bearish. And the same to be said in Q1, 15 billion buying, 4 billion selling, a lot more bullish. And again, with the drop we have seen, perhaps we will see the continuation of this trend into quarter 2. And insider ownership, whilst worth highlighting at 0.33%, we can in fact note in the most recent quarter no movement. In fact, quarter 1 we actually see buying, which we always say is a bullish signal. Management buy because they believe the share price will increase over time. And for those that do want to see all the insider buying and selling in the more recent period, we'll show you for full transparency. In fact, you will notice the most recent insider was the buying highlighted 17th of January, where they added 1,000 shares, costing them $512,000. There are some selling, although we are talking about now in 2024. And as we always say, insider selling, not typically a bearish signal. They sell for many reasons, personal and financial. Now for consistency, we'll highlight these super investors where 17 of them hold this in their portfolio. And in the most recent quarter, whilst we don't have the likes of Bill Ackman, Bill Gates, Warren Buffett, we do have some others that have trickled in. As always, we will highlight the more popular ones, so make sure you are subscribed and notification bell is on. But we can see the changes, in fact, to what we have at the moment are very small in terms of the portfolio composition. But again, information is here, and you can also note quarter 4 as well. Now, we just talked about their revenue, which has been very strong in terms of growth, 157 billion, now sitting at 400 billion in the latest year. That is a more than double, in fact, from 10 years ago. But we really want to understand, what does the bottom line net income tell us? Is the story fairly similar? Is the growth pretty consistent? And for the large part, the answer is yes. Going from 6 billion 10 years ago, now sitting at 14.4. And whilst we do get the drop from 2023, based on the trailing 12 month, it is expected to continue that upward trend. So all the signs at the moment do look good, whilst we have had a few potential red flag indicators. And we can also show you an update to their total health, cash versus total debt. Cash been increasing over the last 10 years, 11 billion 2015, now sitting at 31 billion. And remember, one number here, pure isolation, isn't going to give anything away. So we compare it to their total debt numerically and directionally, which as we can see, going from 32 billion 10 years ago, now at 81. So that is quite a rapid increase, and it is larger than their cash. That is why we look to the net debt to EBITDA. At the moment, looks good near the 1 mark, but as always, something we should keep our eye on. And for those that want to understand, is the issue with UNH, or is there also some sector-wide issues that haven't helped the company? So when we do compare it to others like ELV, CNC, Humana, and a few more popular names, we can see over the last 12 months, even with reinvesting those dividends, they are one of the worst performers, down 25%, will be larger when the market opens. Comparably, ELV also down 22%. So pretty much the industry as a whole hasn't performed that well at all, at least in the last year. Over the last 5 years, they are up 42%. Not too bad, not too great. As we can see, fairly mixed performance right across the board. And then when we look over the last 10 years, they have performed fairly strong, up 269%, one of the better performing. But who knows what the next 5, 10, 15 years brings, because as always, past performance is not an indicator of the future. And for those that just want to see that against the S&P, well, they've massively underperformed and down 25%, the S&P up 12 in the last year. Over the last 5 years, also massively underperformed, up 42, S&P up 104. And over the last 10 years, they have outperformed, up 269, S&P 175. But remember, just because they've outperformed over the last 10, it will be difficult now to incorporate how they will perform moving forwards. They did, in fact, as we said, suspend their guidance at least for 2025. And if you don't have conviction that they will be able to outperform, you can always consider a low-cost ETF like VO that does track the S&P. And before we just jump into our valuation, we want to let you know we have released our latest free weekly article. We draw on every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a copy of severely undervalued stocks for the month of May. Lots of information for each one, the upside that Wall Street themselves see over the next year, as well as stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now jumping into our valuation, it is unchanged from the episode we did a few days ago at $506, which is just purely the average of these 4 models that you see on screen. Now we can run through each one very briefly, where we have Graham's valuation. We have the earnings per share based on fact on the cut that they did have a few days ago. It is now suspended, so do bear that in mind. And with the long-term growth rate and the AAA corporate bond yield, we do get an intrinsic value that now shows undervaluation, although fairly marginally. And remember, we don't look at any one model in pure isolation. Then move on to the multiples valuation model, companies in a similar sector and size, average P multiplied by the EPS to give us another marginal undervaluation signal. Then the dividend discount model, where we get the intrinsic price showing massive undervaluation. Remember, average growth, double digit, love to see that. We've gone a little bit more conservative at 6.75. And then when we move on to the final model, DCF, with the free cash flow year on year, average growth is 14% over the last 10. We've got a lot more conservative at 6. With the discount rate, we've got the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 593. All 4 models now, unlike what we saw in the previous episode, giving undervaluation. And as we said, intrinsic price on average 506. And don't forget, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for UNH or any others. But we're not just done there, because we always add a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at 456, then we keep going till it's near the current trading price. And right now, in essence, not a 35% MOS, that would be 329, but you are getting at least 30% up to 354, which does look to be an incredibly attractive proposition right now. With Wall Street themselves, even with all of the cuts they have done over the last few weeks, see this at 560 over the next year, 65% upside. Now, it has been one of the worst performing stocks in the S&P in 2025. Does it mean it will turn around just because it has been hammered hard? No, so do bear all of these factors in mind, and remember, if you are investing for the longer term and you do have conviction that this will go back to the strong levels we have seen, as well as what management believe in terms of their long-term growth rates, this could be a fairly attractive opportunity. As always, give us your thoughts below. UNH, do you see this now as a buy, hold, or sell? And don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at the Patreon, where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.